Hello and welcome to Bazaar Morning Call, live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel, as always. It's a not so chilly but nice morning, right? Tuesday morning.
It's the best we can get in Mumbai in terms of the chill,
It's the best
right?
weather, right?
Yeah.
Absolutely the best weather. But one, I always think compared to Delhi, I don't know. Maybe I don't know, Nigel, but you being a Bombay person, to kind of go out in the evening and sit out, right?
It was beautiful last night.
It
was beautiful last night.
It's
last night was a little bit more chilly, I think so. I mean, in the morning it speeded away, but otherwise it was very pleasant last
I
night.
think these first few weeks of Jan are the only time we get in Mumbai is officially winter, right?
Yeah.
But you have to negotiate the pollution as well, all the smog and everything.
Yes,
but
yeah.
through that, if you can look through that, then you can see the chill and feel it.
Absolutely. The markets are not feeling the chill. Markets are actually quite warm and cozy. At least that's the way they've started 2023. And it's a distinctively different market and different feel to 23 as compared to 22. Maybe I've spoken too early. Maybe I will regret. But it does feel like, after what we saw on Friday last week, that things are looking a little bit better. Market participants overnight in US continued to trade the data from Friday, which is basically the ISM services and the jobs data, etc. There was nothing fresh. There was nothing new, no new information per se. Markets at one point were up some 2.5%. It was almost like a repeat, deja vu compared to Friday. But by close, they gave up gains. So take a look at the Nasdaq, for example, which is the one which did the best at close. It was up 0.63%, but it sold off 1.6% from the highs of the day. No particular one single reason for it, but both the S&P and the Nasdaq came off the highs, but techs did the best. The big global event, once again, is the macros. And there are two things, by the way. That today, later, we have the Fed Chair, Jerome Powell, who will make a speech. And then Thursday, there is the CPI. We'll get to the CPI, I guess, tomorrow. But let's tackle what markets are expecting from the Powell speech. Or rather, what they're not expecting. What they don't want the Fed Chair to do is push back against market pricing. What do I mean by market pricing? After the recent drop in the sort of the wage portion of the data, the jobs number, and the ISM services drop, the terminal rate pricing is now firmly below 5%. This is what the Fed will do at its peak. It's now below 5%, firmly below 5%, which means that this includes a 50 basis point cut, which is priced into late 2023. So markets, in terms of trying to assess what the Fed will do, has lowered how aggressive the Fed will be. The markets don't want Fed Chair Powell to push back against this pricing. He may. Just last week, when we got the December FOMC Fed minutes, what did the minutes say? The minutes said the markets get very loose in terms of financial conditions, and that is exactly the opposite of what we want. We want tighter conditions, not looser financial conditions. Markets rallying is looser financial conditions, and that is something which makes our job harder to do, which is control inflation. Asset prices go up, and they kind of seep through into the economy. So that is what they don't want. So if the Fed minutes, the December Fed minutes are any indication, we may hear something about that. By the way, from the time that the Fed minutes were released, markets have rallied quite substantially. The dollar is down about 2.5%. Equities are up some 3.5%. Yields are down substantially. Actually, the big move has happened in the yields market, the rates market in the US. So we'll see. But I think that's the big risk. If Fed Chair Powell, despite the cooling off in data, comes out tonight and says, well, you guys are still overdoing it. You guys are still getting too joyous at the first hint that inflation is cooling. We plan to do more. This is a long-drawn game, etc., etc., etc. We know the drill. All right. Let's just come back to the market here, the Nifty, right? So on the index, 18,200 is the first level to take out on the upside. The 20-day moving average, which was around 18,200, is now 18,194 as of yesterday's close. This 18,200 is also, as I explained yesterday morning, the 38% retracement of the full fall from the all-time high to the lows in December, 26th of December, which was 17,774. So it's a cluster at about 18,200, exactly about 100 points away from where we are. Bank Nifty has, and the lows, of course, at 17,774 should provide support. The Bank Nifty has resistance at 42,860. It's a retracement of the fall. And then there is the 20-day moving average, which comes in at 42,985 for the Nifty Bank. And for the banks, the support should come in around Friday's low of around 41,880. The market here also pulled back into close. I mean, the broader markets also pulled back. Market breadth, which was far in favor of advances, that closed the gap a little bit. But I would say on the Nifty, at least, it was still a solid close. And perhaps there is a little bit more to go. We can discuss the implications of what the TCS numbers can do one way or the other a little later. But I think they should not have an overbearing influence on what the index setup is this morning as we begin another session of trade. Guys, hi, morning.
Hi, morning. Morning, Nigel. And you know, the SGX Nifty for now is indicating that the start will be slightly on the muted side. It's down about 20 odd points. But there are a couple of positive triggers that I'm watching this morning, which perhaps could take the markets ahead. One is the TCS numbers. They were not as bad as what the market was fearing. So, you know, this is something, of course, that the street would like. The fact that the revenues have beaten street estimates, it's almost a 3% growth quarter on quarter. They're also confident of exit margins of 25%. The only niggling worry is that Europe is a big concern for them, so they're cautious on the growth outlook. But largely, you'd have to say that these are not as bad as the market was fearing, and the stock had a rally as well in anticipation of that. So that's the first positive. The second is that the FI selling has reduced considerably. So yesterday, FIs barely sold about 200 odd crores, and there was large buying from DIIs. So have we found a floor around that 17,900 mark, which is the 100-day moving average? The US markets as well consolidated their gains. The Nasdaq ended well in the green, up about 60 odd points. It's the second day of gains over there, and very strong gains in the European markets too. The FTSE was up over 200 odd points. So the big question is, the Nifty managed to conquer that 100-day moving average of 17,900. Does it become the near-term floor for the market? Looks like, at least with these positive cues, that level could hold. The pullback could perhaps extend itself. And of course, there are other positives as well. Brent continues to be below $80 a barrel. So we have more positives than negatives this morning. Let's see. For now, the SGX Nifty is indicating a slightly muted start. But I guess a lot will also matter on the commentary that the TCS management makes. So we'll await that very soon.
Well, that's right. You know, Sonia, for me, the biggest cue coming in overnight was the dollar index. You know, that's cooled off, and I like that. You know, from an emerging market perspective, for me, that's the big cue. It's cooled to around 103 odd. So that's good news. But yesterday, we had a great trading session. A pullback was on the cards, and maybe, in fact, on the data points that came out of the United States, that was the reason that we pulled back. So from oversold levels, we did see a good pullback. The good point as well is 17,800 yet again got defended. So in the last 20 days or so, we have gone to that level twice, and it's got, we have pulled back from there. The Nifty Bank, you know, the intraday chart is telling you the picture. It was underperforming till around 2 p.m. odd, but then it found some form, and you like that as well. And hopefully that continues from a bullish perspective. On the institutional flows, well, the FIs, as Sonia said, net sold close to 200 crores. That's the lowest in the last 12 sessions. You know, that's the lowest since December 22nd, in fact. And institutional flows, that's the DI and the FI number. I look at it together. Last few days, we were hovering with a net sell number of around 1,800 crores. Well, that turned yesterday. We had a net buy number of close to around 1,500 crores. Part of that, you know, that FI smaller number coming in is what Nimesh had to tell us yesterday in the final hour of trade. He said there was some ETF buying that was likely. So maybe because of that, we had a bump up out there. And that's why the FI net sell number was much smaller. What are the FIs doing in the F&O market? Well, there was some short covering. And for the market on the whole, the Nifty Bank, there were bigger shorts that got covered out there. That ties in perfectly. Yesterday, the FIs added some long positions. They covered some short positioning. And now, you know, the short positioning has come down to around 51%. At the, sometime last week, it was 64%. It's come down to around 51%. So some part of the short covering bounce has played out. On the option side, well, they were writing calls. They got stuck on the wrong side. There was calls that were written earlier. They got covered. And put writing came back into play. 18,000 put, 18,100 put. Both of them got very active yesterday. And I'm looking at the 18,100 put. The premium out there was around 75 rupees. At the start of the day, it was around 140 rupees. So you punch that number in, and you get a support of around 18,000, 18,030. That's for today itself. At higher levels, you're looking at the 20 and the 50 DMA. The IT stocks will react today, but for me, the Nifty Bank, that's the joke on the pack from a bullish perspective. Can it get past the 20 DMA? It's around 100, 120 points away from those levels. So this dip at some point of time, my gut is going by the data points. We have some unfinished business on the upside till around 18,250. So maybe get a deeper gash. That should be a good entry opportunity.
All right. Well, let's wait by lots of cues lined up later this morning. So we will begin with the equity call of the day. First up, we have Chetan Seth of Nomura, who says the developments over the past few weeks continue to support their constructive view on Asian equities in 2023. He says China's reopening momentum has been faster than market expectations, though it has resulted in a temporary surge in new cases and depressed mobility. He thinks investors should and will look through and focus on an eventual economic earnings recovery later in 2023. On the global front, he says US inflation has been moderating with multiple months of declining month-on-month inflation prints. He remains tactically bullish on China stocks and believes that there are legs to this reopening, recovery-driven rally.
Well, let's get you some money market views as well. Bhaskar Panda of HDFC Bank says that the dollar index moved down a bit overnight in the hope that the US policymakers may be able to manage a soft landing. He says oil and metals have firmed up a bit. And surprisingly, the dollar-INR pair has moved down yesterday as INR gained against the dollar, riding on better flows. He says since dollar index is easing and there is optimism on flows, expect the dollar-INR pair to trade in a range of between 82.2 to 82.5 to a dollar for the day.
All right, on the bonds, Bhaskar Panda says yields and benchmark indices have tapered a bit on the basis of perception of US rates and favorable oil prices. He says the trend is expected to continue as he expects the 10-year benchmark bond yield to trade in a range of 7.3 to 7.35% for the day.
All right, well, we have a lot of stocks that we're going to be tracking for you, and we'll get to that in just a bit in our special Top 10 segment. We're looking at Big Boy, TCS, Tata Motors, Sona BLW, Precision, Lupin, IRB Infram, IRB Invit, ONGC, and KRBL. All of them on the back of positive news flow. While on the flip side, you have JSW Ispat and Tega Industries. They are stocks that could open up in the red.